Hey everyone, welcome to this week's Money Minutia, where I'm taking some time to go over simple but incredibly important concepts about the money and finance industry. This week we're talking about debt. What is it, and is it always as bad as people say? Now, to begin with, what is debt? Debt is basically you're borrowing money from a lender with the expectation that you're going to pay that money back with a percentage of interest rate on top of it. The first one we're going to talk about is your house, or rather, the mortgage you get to purchase your house. Not many people are going to have the cash to purchase a house outright. So you get 5 to 10% usually of a down payment. And then you go to a mortgage broker who finds you a lender to lend you the rest of that money to purchase the house. Now, that debt is what's called secured against the value of that house. As such, the interest rates are incredibly low, sitting around 2% currently. And if you use the rule of 72 that we talked about in the last video, that debt will double every 36 years. So, being debt, the higher the number, the better. Next up are lines of credit. Basically, line of credit is you get a balance that you can borrow against from one of your standard banking institutions, TD, RBC, etc. And then you pay an interest rate on the balance that you've currently borrowed. So say you have a line of credit of $10,000, you have $2,000 that you've currently borrowed, you're paying around 6 to 8% on that $2,000 that you have borrowed. And then that interest just accumulates on the line of credit as it builds. Now, as you can see with the rule of 72 again, it's going to double a little quicker every 12 years at that 6%. Next up is probably the most common form of debt is your credit card. Everybody and their grandmother has a credit card. Their interest rates are pretty high. They start at around 20 or 19.99, and as a lot of places like to quote it. And they can increase if you don't keep up regular payments up to 30%. As you can see, every 3.6 years, that debt will double against you if at that 20%. Last but not least, just to touch on these, they're payday loan places. You go get pretty quick cash. They're very low barrier of lending. It's usually if you have a bank account and you have an income, they'll lend you money. The downside is that their interest rates are incredibly high, upwards of 48%. So if you're borrowing month after month, after a year and a half, the amount that you've paid them back will be double what you've borrowed. Thankfully, it's not impossible to get out of debt. It's not a death sentence. There are multiple options for debt relief. One of the first, if you're lucky enough to have access to that mortgage or the value of your house, you can refinance your mortgage using the available value in your house. So, for instance, if you have a house that's worth $500,000 and you have a $200,000 mortgage currently still on it, average value for equity in a home is about 80%. So you have 80% of that 500,000 available to borrow. 200 is already in your first mortgage, and now you have another 200,000 that you have access to if you were to refinance that mortgage. And it would be again at that low 2% interest rate. Next up are consolidation loans. If you don't have that equity value available in your house, but you're still like, you got good credit, you keep up with your bills, you can usually go to the bank. They'll give you a chunk of money, probably closer to that line of credit interest rate, and you'll be able to pay off all your debts with that. Now, if you don't have any available home equity or your credit's not quite where it needs to be to have access to those consolidation loans, and maybe you're a little bit over your head when it comes to your debt load, I encourage you to look into something called a consumer proposal. Now, the brokerage I work with is partnered with a fantastic firm called Four Pillars, and they work with creditors on your behalf to get your account settled at a greatly lower rate than what you would have normally had to pay. And they're able to do that with you making monthly payments. And your last option is, of course, bankruptcy. You want to avoid this if at all possible, but if you do end up there, I want to let you know that it's not the end of the world. You can come back from it. It's a short process if it's your first time and relatively painless. I know because I actually had to go through it a number of years ago. I was helped out by a wonderful lady who got me out of a tight spot. And now I'm teaching people about money and finance. So that was probably one of the biggest catalysts for me to start on this finance journey. And I'm happy for you to join me. If any of the topics in this video series are something you'd like to learn more about, please reach out to me through direct message on whatever platform it is you're watching this on. I would love to have that conversation with you. And remember, it's the little things in life that usually make the biggest difference.